Welcome back to Investing Talk Podcast.
Today we're looking at LM Funding America.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of this company. This is it's a fascinating name because they operate what you might call a dual revenue model.
Right. They're not purely a crypto miner.
Not at all.
Yeah.
And understanding that balance is really the key to understanding their whole risk profile.
That's the part that drew our attention. We get a lot of requests for pure play miners, but this company combines specialty finance, which is their legacy business, with this really significant aggressive pivot toward Bitcoin.
Exactly. And we should probably define that legacy side first. The specialty finance segment. It provides a certain level of stable, non-crypto income. Now, it's not the growth driver here, but it provides a unique buffer.
A buffer that a lot of pure play miners just don't have.
They really don't. They live and die with the price of Bitcoin. This finance segment, it helps offset some of their fixed public company overhead costs, which gives them, a stability advantage when the crypto market gets volatile.
So, okay, specialty finance is the foundation, but the Bitcoin mining, that's the growth engine. And what really stands out is that their Bitcoin mining segment is already profitable. On an operating income basis, I mean.
That operational profitability is massive. It means the mining operations themselves are generating more cash than they consume, before you account for interest, taxes, and all the big administrative expenses.
And that's the mechanism that creates this self-funding flywheel we hear about.
That's it. They're generating Bitcoin that they can actually hold, rather than having to sell all of it immediately just to cover costs.
Which brings us to their treasury, their commitment to it. We're not talking about some small speculative position here.
No, not at all. As of the end of Q3 2025, they were holding just over 304 Bitcoin. That is a serious war chest.
And we should probably emphasize why that number is so important to the stock's valuation.
Yeah, definitely. That treasury was recently valued at, north of $34 million. For a company this size, that is a substantial tangible asset base. It's a massive liquidity cushion on their balance sheet.
Investors often look at that treasury value per share almost like a floor for the stock, don't they?
They do. But let's maybe challenge that accumulation strategy for a second.
Okay.
They'll funded a big part of that treasury with a $23 million capital raise back in August 2025. Now, while it was disciplined, issuing shares to buy a volatile asset like Bitcoin is, well, it's dilutive.
It is. So are shareholders really being rewarded when the company issues shares just to pivot that capital right back into a digital asset?
That's the necessary critique, you're right. The immediate effect is dilution. However, the intent behind it signals this aggressive conviction in their long-term strategy. They're trying to maximize Bitcoin exposure before its next major upswing.
And the key thing is that most of those proceeds went directly into buying Bitcoin.
Almost all of it, after expenses. And that kind of clear, focused deployment is what separates the strategic accumulators from the miners who are just trying to keep the lights on.
Okay, so they raised the capital, they built the treasury. Let's pivot to the operational side, because the execution is what makes the whole strategy work. Let's talk capacity expansion.
This is where the story gets really compelling, I think, because the move they made in September 2025, it was incredibly opportunistic. They closed the acquisition of an 11-megawatt mining site in Columbus, Mississippi.
For just $4 million.
Just $4 million.
Can you give us some context on that? What does $4 million for 11 megawatts mean in industry terms?
It's a huge win. I mean, when the industry is hot, a new build-out for high-quality infrastructure can cost anywhere from, say, $750,000 to over $1 million per megawatt.
Wow.
Yeah, so if we take a conservative estimate, call it $800,000 per megawatt, a new build for 11 megawatts would cost nearly $9 million.
So they essentially got this existing operational infrastructure at a massive discount, at least 50% off replacement cost.
Precisely. It was a highly accretive valuation. And it wasn't just a small bump either. It expanded their own capacity by 42% in a single move.
And that pushed them way closer to their overall 26 megawatt target.
It did. And the location wasn't random, right?
It wasn't just about the cheap price, it was about efficiency.
Absolute critical point. The Columbus facility is a low-cost power site and mining profitability. It's almost entirely determined by the cost of electricity.
So bringing that site online immediately lowered their overall operating cost.
Immediately. And we saw that impact right away in the reported margins.
Right.
Yes, that's the beauty of operational leverage. They're direct mining margins. So the gross profitability from the mining activity itself jumped from a strong 41% in Q2 to an even more impressive 49% in Q3.
That's a huge 8-point improvement in one quarter.
It's substantial, and those operational improvements translate directly to revenue.
The company reported $2.2 million in revenue for Q3 2025, a 74% sequential increase from the prior quarter.
That efficiency gain is fueling the top line. It validates their entire strategy of executing on these opportunistic, low-cost power acquisitions.
So this is what you'd call the transition point then?
I think so, yeah. They're moving from a development story, buying and building, to a clear growth story where existing operations are being optimized. The expectation now is for a material earnings inflection, especially as we see Q4 numbers and head into 2026.
Because they'll get the full contribution from that low-cost Mississippi facility.
Exactly. They are positioning themselves for dual leverage to Bitcoin price appreciation. One, through higher mining revenue, and two, through the mark-to-market gains on that big treasury.
Let's talk about capital management for a moment, because even aggressive growth companies need to show some commitment to shareholder returns. In November 2025, the board authorized a $1.5 million share repurchase program.
That's a classic signal of management confidence. When a company initiates a buyback, they're basically stating that they believe their stock is undervalued. It's a commitment to returning capital, even while they're in heavy growth mode.
And they still have huge flexibility for future moves, thanks to that $150 million shelf registration. Could you quickly explain what that is and why it matters here?
Of course. Think of a shelf registration like a pre-approved menu of fundraising options that sits on the shelf, ready to use. It doesn't mean they're issuing shares today, but it gives them the ability to move fast when an opportunity comes up.
Like another cheap mining site.
Exactly. Like if another low-cost power site comes up for sale unexpectedly, it's dry powder, ready to go, without the time lag of going through the whole regulatory process every single time.
Okay, so stability from the legacy business, operational efficiency from the new sites, and capital flexibility.
Yeah.
But investing always has risk, especially in the crypto space. What should our listeners be most wary of?
Well, the primary risk is the obvious one. It overrides everything else. Bitcoin price volatility.
Right.
That operating profitability of their mining segment, that 49% margin we talked about, is highly sensitive to the price of Bitcoin. If Bitcoin drops significantly, that margin just evaporates. And the multi-million-dollar treasury value is, of course, directly tied to that price.
And there's also the question of financial stability during this whole transition. I mean, we have to address the elephant in the room. Despite the strong Q3 revenue, the company reported a substantial trailing 12-month net loss.
Yes, and that distinction between operational profitability and the PTM net loss is vital.
Explain that.
Operational profitability means the mining activity itself is working. The TTM net loss means they're still heavily burdened by, corporate overhead, interest expenses, and all the costs that come with rapid acquisition. It tells you they're still very much in a turnaround phase, not a stable, mature profitability phase. Not yet.
And the other big hurdle for investors is often dilution. You mentioned the capital raise, but they also did a warrant repricing in November 2025, which created what analysts call an overhang.
This is arguably the most complex risk factor. A warrant is basically an option to buy stock at a certain price. When the stock price falls way below that exercise price, the warrants are worthless.
So nobody converts them and the company doesn't get the cash.
Exactly. By reducing the price to 97 cents, they incentivize those holders to convert immediately, which brings much-needed capital into the company very quickly. It's a trade-off. You get capital for the treasury build-out, but the consequence is immediate dilution. More shares flood the market.
And that puts temporary downward pressure on the stock, the overhang.
That's the overhang. So
Right.
It really sounds like the market is pricing in that risk right now, the volatility, the dilution, but the company is executing aggressively to get to that earnings inflection point.
That's a good summary. The warrant reset, as dilutive as it is, often happens at a technical low point. It helps set a new baseline and injects the funds needed for growth. It turns risk into capital.
So if you're holding this stock or maybe considering it, what are the biggest near-term catalysts to watch for?
The immediate focus has to be the upcoming Q4 2025 earnings report. That should be out in late December or early January.
And that's the first period that'll reflect the full operational contribution from the Mississippi facility.
Exactly. So investors will be looking at two things: Capacity utilization, are they running it efficiently? And critically, can those 49% mining margins be sustained or even improved?
And beyond the hard numbers in the Q4 report, the market is always looking for the next move, especially with that big shelf registration.
Yes. The focus will shift back to their ability to hit that 26-megawatt target. Management has shown they can make good opportunistic acquisitions. So, market chatter about more acquisitions or a strategic partnership in the new year, you can't ignore it.
If Bitcoin maintains its momentum and they keep scaling up with low-cost power, that operational leverage is going to create a really powerful tailwind for them.
Ultimately, this company is positioned as a levered proxy for Bitcoin appreciation, backed by a unique, self-funding operational model. The next few quarters will really tell us whether they can capitalize on that efficiency and transition from a high-risk development story to a clearer, more stable growth story.
You'll want to keep watching those operational reports very closely.
Excellent analysis. If you want more in-depth looks like this one, hit that subscribe button, and we'll catch you next time on Investing Talk Podcast.